Good morning, everyone. I hope that you're all doing well. I want to welcome you to the second video in the 2025 Trading Protocol series, where in this lecture, we're going to discuss environment selection and why exactly environment selection is so important and crucial when it comes to trading. Because although we have a protocol, a set of rules that we need to follow, there are specific conditions, specific environments that we want to engage, because that increases the probability of the protocol that we're outlining playing out successfully. And so without further ado, let's get into today's lecture on environment selection. So to lay out the table of contents for this lecture, firstly, we're going to review the protocol and where exactly are we in terms of the protocol so far. We're then going to discuss what exactly is environment selection. We will then discuss low resistance liquidity runs and high resistance liquidity runs and the difference between the two. We're then going to move on to answering the question as to why environment selection is so important. We're then going to lay out how exactly we're going to conduct our environment selection. And then finally, I'll set a homework assignment for you to complete. So just to recap, from the introduction lecture, you've already seen this flowchart. This is the protocol that we're building. It has 15 steps. And currently, we're right at the beginning at environment selection. And so this is the environment selection chapter. This comes before we start to do our higher time frame analysis. We're essentially laying out when we are going to engage and when we are not going to engage. And the tools that we're going to utilize are firstly the economic calendar, sessions of interest, and intermarket relationship. So what exactly is environment selection? Well, environment selection is where we choose to trade during market environments where we anticipate low resistance liquidity runs and avoid high resistance liquidity runs. Now you might be wondering, okay, well, what is a low resistance liquidity run and what is a high resistance liquidity run? Well, during a low resistance liquidity run, price will deliver into our drawn liquidity, so into our anticipated direction, utilizing discount arrays as perfect supports and premium arrays as perfect resistance. And so what I'm saying is price will deliver to where we're anticipating price to deliver in a clean fashion, where the expansions, retracements, expansions are very clean, and discount arrays are being utilized as supports, and premium arrays are being utilized as resistance. Now, during a high resistance liquidity run, price will deliver into our drawn liquidity, failing to utilize discount arrays as perfect supports, and premium arrays as perfect resistance. And so in other words, price is going back and forth, very choppy delivery. We're going back and forth between arrays, consolidating, expanding, going from buy program to sell program to buy program. Very messy delivery. Now, just to show you what a low resistance liquidity run would look like, if we're anticipating the drawn liquidity to be higher, price will expand higher, retrace lower into a discount array, this blue box, expands higher, retrace into discount array, utilize as supports, expands higher, retrace into a discount array, utilize as supports, expands higher, retrace into a discount array, utilize as supports, and expand higher. Very clean price action where we expand, retrace, expand, retrace, expand, retrace, expand, retrace, expand into our drawn liquidity. Conversely, in a sell program where the drawn liquidity is lower, price will expand lower, retrace into a premium array, expand lower, retrace into a premium array, expand lower, resistance, expansion, resistance, expansion. And so, in other words, we have very clean price action where price is just delivering towards an objective by expanding, retracing, expanding, retracing. An example of a low resistance liquidity run, if we assume the drawn liquidity is higher, is we have these PD arrays on the left side of the curve. So we have this bearish fair value gap and bearish order blocks that formed on the left side of the curve within this market maker buy model, where we have left side of the curve, right side of the curve, meaning sell program into buy program. And we can see that premium arrays that formed on the left side of the curve, once it's spaced above, become discount arrays. And so what we can see is premium arrays that formed on the left side of the curve, once it's spaced above, become discount arrays and are utilized as supports. So we displaced above this imbalance, utilized it as supports, expanded higher, displacing above this imbalance, retracing into it, utilizing as supports, expands higher, above these bearish order blocks, which have now become a bullish breaker. If you don't know anything about PD arrays yet, don't worry, we're going to cover this. But just know there are specific signatures that we look for in price that we call premium and discount arrays that we anticipate being utilized as either support or resistance. These up-close candles are bearish order blocks that took out sell-side liquidity, and buy-side liquidity becomes a bullish breaker. Once it's placed above, should be utilized as supports, and then price continues higher. This is a low resistance liquidity one, where price will just expand higher, retrace lower, expand higher, retrace lower, expand higher, retrace lower, expand higher, into our drawn liquidity. If we look for a bearish example, we've got this bullish order block here, bullish order block here, bullish order block here, that formed on the left side of the curve. Once it's placed below on the right side of the curve, is utilized as resistance, utilized as resistance, utilized as resistance. And so in other words, what we're saying is during a low resistance liquidity run environment, premium arrays will act as perfect resistance on price, because this is a discount array that formed on the left side of the curve, which becomes a premium array once it's placed below, and it's being utilized as perfect resistance, perfect resistance, perfect resistance. And the opposite is true for discount arrays. This would be a premium array on the left side of the curve. Once it's placed above, on the right side of the curve becomes a discount array. Perfect support, perfect support, perfect support. If we now take a look at a high resistance liquidity run, we can see prices going back and forth, back and forth, back and forth. Very messy price action, because in the previous example, we anticipate this discount array to be utilized as supports, this discount array to be utilized as supports. Instead, what we see is price goes above it, then below it, then above it, utilized as supports, but then goes back below it into the previous discount array, then goes higher. Very messy price action, meaning we're going from buy program to sell program, back into buy program, consolidating, taking out liquidity, going higher. And the same true here. Goes above, then below, then above, then below, consolidates. So very messy price action. The discount arrays and premium arrays that form on the left side of the curve are not being utilized as perfect resistance or support on price on the right side of the curve. And this is a high resistance liquidity run. If we look at this market maker buy model, we can see we've got this bearish fair value gap, this SIBI, this imbalance here, this bearish order block, and this bearish fair value gap. Once it's placed above on the right side of the curve, become discount arrays, because premium arrays on the left side of the curve become discount arrays on the right side of the curve once it's placed above. And what we can see is that price consolidates. We then close above its imbalance, fail to utilize as supports, go above it again, as well as this imbalance, fail to utilize them as supports, goes lower, consolidates, goes higher. We then close above this bearish order block, close above it, close back below it, go back into the previous discount array. So we go from buy program into sell program, back into buy program, and then price goes back and forth between these arrays once it's placing above. Very messy price action, but eventually delivers towards our objective. And so it's very clear the difference between this type of delivery here, where it's very messy, and this type of delivery here, where it's very clean. This is what we want to trade. This is what we want to avoid. If you look at the next example, we've got this bullish order block that formed on the left side of the curve. We've got this bullish order block that formed on the left side of the curve. Once it's placed below, should be utilized as resistance. However, price displaces below this price range here, then back above it, then back below it. Price displaces below this bullish order block, then back above it, then back below it. Very messy price action. We're going back and forth between buy program and sell program. And this is what a high resistance liquidity run is, where we go back and forth, back and forth, back and forth. So why exactly is environment selection so important? Well, the reason it's so important is because you can do everything correctly, meaning you can identify the correct drawn liquidity, which is where price is going. You could execute the trades perfectly. You can wait for every single criteria to align. But if you're trading within a high resistance liquidity run environment, there is a very high probability you will lose. Why? Well, because the arrays that you anticipate being utilized as support or resistance during a low resistance liquidity run will fail. And therefore, this will result in unnecessary losses. Therefore, we want to avoid trading during a high resistance liquidity run at all costs. Within a high resistance liquidity run, it doesn't matter how good your analysis was or how good you execute the trades, if price is going to deliver choppy price action, you're likely going to get taken out on a stop loss. Even though price will eventually deliver towards your drawn liquidity, it's going to be very messy and you're very likely to get taken out. So how exactly do we conduct our environment selection? Meaning, how exactly do we avoid a high resistance liquidity run and focus on low resistance liquidity runs? Well, we're going to utilize 3 tools. The first tool is the economic calendar. We're going to focus on days and sessions that price is likely to produce low resistance liquidity runs based on volatility injections for that week. And what I mean by this is based on the economic calendar that we look at each week, we can already see which days and sessions are likely to produce low resistance liquidity runs. And I say likely because, again, we don't know, we operate based on probabilities, but when we discuss the economic calendar, what I'll show you is that we can anticipate low resistance liquidity runs and avoid high resistance liquidity runs based on when those volatility injections are going to be released. And remember, we know that in advance. We can plan our week and our sessions well in advance. Secondly, we need to operate within specific sessions, meaning there are periods within each day where low resistance liquidity runs are higher probability. And what I mean by this is, okay, let's say you validated a day and a session as high probability based on the economic calendar. You also need to take into account that we can refine those sessions within those days to even smaller time windows where the probability of a low resistance liquidity run occurring is much higher. And so we're going to limit our sessions. The third tool that we're going to utilize is intermarket relationship, where correlated or inversely correlated markets are moving in sync. If correlated markets or inversely correlated markets are moving in sync, we can anticipate low resistance liquidity runs. Why? Well, because if one market is telling us we're going higher and another correlated market is telling us we're going lower, what that means is we have two opposing ideas. Therefore, there's a very high probability that price will produce choppy price action because these markets are moving out of sync. This is due to manual intervention where one market will move higher, one market will move lower. Price doesn't have a true direction because these markets should be moving in sync, and therefore we can anticipate these high resistance liquidity runs unfolding. Now for the homework assignments, what I want you to do is I want you to collect 15 examples of low resistance liquidity runs occurring and 15 examples of high resistance liquidity runs occurring. Don't worry about the details, just focus on what they look like. Can you identify a high resistance liquidity run, and can you identify a low resistance liquidity run? And just to quickly show you again, this would be a low resistance liquidity run for a bullish example, assuming the drawn liquidity is higher. This would be a low resistance liquidity run for a sell program where the drawn liquidity is lower. This would be a high resistance liquidity run where the drawn liquidity is higher, meaning we're going higher. And this would be a high resistance liquidity run when the drawn liquidity is lower. And if you just compare this delivery here, where it's very messy, and compare this delivery here, you can see it's very obvious that we want to be engaging during low resistance liquidity runs and avoiding those high resistance liquidity runs. So that brings us to the end of this lecture where we discussed environment selection. In the next lecture, we're going to move on to the first components, that first tool that we're going to utilize to identify those low resistance liquidity runs, which is the economic calendar, where we're going to identify days and sessions in advance that we deem as high probability, where we can anticipate low resistance liquidity runs. And so I hope you found some value from this lecture. And with that, I'll see you in the next episodes. Be safe.